But I just want to be careful with these kind of things and saying these kind of things, because just like the debt ceiling, it's clickbait. It's completely insignificant, the amount of this or that country that might be buying U.S. or selling U.S. Treasuries. U.S. Treasuries are the world's highest yielding debt, the deepest market right now. If you're short the dollar, it's a negative carry trade. It's not that complicated. And I've heard it since I've been in this business. I don't know how many times, oh, I got to short Treasuries because the debt's going up. First of all, let's start with the trend. It doesn't matter right now. We're all turning to Japan. It will matter at some point. That's why Bitcoin is long-term I'm bullish. But right now, the biggest bridge that we have to cross is, as Dave mentioned, we're tilting towards this recession. What typically happens in recessions is the Fed cuts aggressively. This is not an opinion, that's a fact.
Bloomberg Intelligence's senior macro strategist, Mike McGlone, says that the second half of the year could be bearish for Bitcoin and the rest of the crypto markets. McGlone says that risk assets, such as stocks and crypto, could get cheap in the coming months as he believes that an economic recession is on the horizon. According to the macro strategist, the Federal Reserve is still on the path of increasing interest rates, which he notes could negatively impact the performance of Bitcoin and other crypto assets. Risk assets can get cheap in recessions. The cat-and-mouse game between the rallying stock market and watchful central banks could be an obstacle for risk assets. Cryptos are among the riskiest, and the inability of the Bloomberg Galaxy Crypto Index, BGCI, to sustain above its 2018 high in 2023 may be for a good reason. The Fed is still tightening. The BGC tracks the performance of the largest crypto assets traded in USD. McGlone also says that the Bloomberg economics team is predicting an ugly second half for cryptos and equities. Our graphic shows a rare divergence, with the NASDAQ 100 stock index breaking higher in the BGC and falling in Q2. Federal funds futures in 1 year, FF13, are a liquidity gauge. Adding rising rate hike expectations to a climbing stock market may put a ceiling on crypto prices. The BGC has rallied in 2023 by about 50% to June 1 and the NASDAQ 30%, which may shift the bias toward what's typical in recessions. Risk assets can get cheap, he tweeted. Let us now get into the video as McGlone shares his macro insight on the Fed rate hikes, debt ceiling, and the state of cryptocurrencies, especially Bitcoin.
Key thing I keep watching is every time I look on the Bloomberg terminal, I see we still have these bars that show they're going to be hiking in the July or June, July meetings. And I look at that and there's really no chance I see of things like an end to this deflationary forces we're seeing in commodities. Bloomberg Commodity Index is down almost 30% on a 1 year basis. We're seeing a little bounce in crude oil today, but I don't really see an end to that until you get well past an easing cycle. And we're not even started yet. So we heard trickling every day now. We've seen trickling downward in China, which has been my expectation for years, but not doing very well. And of course, they just pissed off their best customers, Europe and US. So that's kind of a problem, major disinvestment. But in the shorter term, the key thing is about OPEC plus meeting cuts this week. And it's silly how people who are still trying to play that bullish game in crude oil, yet it's been in bear market since 2008. And I did say 2008 because that's when it peaked, and last year made a lower high. And people keep looking for that old scenario by looking at this old supply side that they still matter, but less so every day. And so we're getting a bounce again in crude oil, and that's what's been happening. We get a bounce on the OPEC cuts, and then it goes back downward to trend. So I see crude oil right now, it's pushing towards 75. It's still going to head towards 50. Natural gas has already done the equivalent. Commodities always go towards their cost of productions in the long term, particularly when you've seen kind of dicey inflation or economic demand, which is not so great. So they always go towards cost of production. And the key thing I'll end with that's so important we need to point out is cryptos are showing divergent weakness now. This is on a quarter, on the whole quarter now. Q2, the Bitcoin's down 6-7%. Bloomberg Galaxy Crypto Index is down about the same. And the NASDAQ's up about almost 10%. That's a sign of divergent weakness. Now, people keep saying the correlations have broken down. I'm like, yeah, they're breaking down the wrong way. The fastest horse in the race is warning everybody, warning us that there's a problem. And I know I have to say this very carefully on this program because we all have to listen to ourselves and our views. Is more McGlone saying what we don't want to hear, or is McGlone saying what he really thinks and warning us? And this is one thing we always have to be careful. I add it myself as trader and ex-trader, not like Dave who still runs money and you. I'm not out to I'm just like to point facts of what's happening. And I have to sometimes, I know in 2018, a lot of crypto people get very upset with me for pointing out facts and my views, but this is a fact in crypto space. My sense is most people think the worst is over, yet there's a good chance it might not be. Back to you.
A notable observation from McGlone's market analysis is the unusual weakening of Bitcoin, copper, and equities in China compared to the stalwart Nasdaq 100 stock index. Furthermore, the fact that Nasdaq's performance alone could uplift the entire market contrasts with the rising expectations of a Fed rate hike. These factors have eventually led him to conclude that Bitcoin, despite its strength, may be too young to outperform traditional safe haven assets like gold in the event of a U.S. economic contraction. He continues his review and also advises against making investments just based on what some random influencer or self-proclaimed trading guru says.
For 40 years, we've had a blip, we're heading back down. But there's key things sometimes that Dave and I have learned that's inherent in what we do, and that is absorbing, studying, and listening, and reading and studying headlines 24/7. And it's something I've been doing for decades. And when I just saw that headline this morning, big U.S. banks face 20% jump in capital requirements, it's like, I'm not going to bother to click through that story. I just look, okay, the macro is already bad. We're already seeing a major jump in money leaving banks and going to money markets and two-year notes. And it's classic fractional reserve bank contraction. It's just, you can't face it. It takes a while. And then I see that headline, okay, well, let's just throw gasoline in that fire. So I just don't, it's one of those things that also you have to also remember in this business is very important to focus on the forest of what you're looking at and ignore those little trees that'll knock you off your view. And that's what I see. The stock market's a pretty good tree lately, but it is actually, I think, aggravating my macro view that this is the biggest reset of a lifetime by keeping that Fed emboldened, by keeping those rate hikes still hanging on over our head, as so many other things are collapsing. And the people focus on the lagging things like unemployment. That's so not important. Let's look at the producer price index. The fact since 1948, it's never dropped as fast as it is now. And then I say that as a fact should scare me. It should scare everyone. And what is being done to help alleviate that? Nothing. It's still going that. And the fact that we're having bank deposits on a year-over-year basis drop at the biggest, the highest rate in our database since the 50s. And what's out to stop that other than maybe just a pinprick every time one or two banks fall? Nothing. The macro's still bad. That's why I look at the big picture. You have to think at least 12 months forward. And that's where I'm still concerned that you see the Fed funds rate 12 months is still around 5%. And that's still restrictive because if I'm going to get 5% and guaranteed 10% in 2 years, why would I invest in any risk asset, particularly if you start rolling over like cryptos have been doing? Treasury is the most leveraged market on the planet. You can get that financing for just about free. But to me, this is also part of the macro. Let's ask ourselves, can we not expect a reciprocal response to the biggest liquidity pump in history that's dumping at the greatest pace in history? And we've never raised rates this fast on a global basis. It's just logical, yet the market's already priced that, it's okay. But that's human nature. And you pile on, like this analyst is bullish and that analyst is bullish. And I love hearing these strategies when people say, yeah, but so-and-so said this. And I say, well, what's their vested interest? They have a vested interest in being right and selling you that crypto or selling you that stock market going up? Or the crude oil going up and being right, or is it follow what they're paid to say these things? You hear these major strategies from major banks coming out with these bullish economic things. I'm like, that's the difference with me. I'm paid to be right in the long term.
Saudi Arabia will make a deep cut to its output in July on top of a broader OPEC Plus deal to limit supply into 2024 as the group seeks to boost flagging oil prices. Saudi's energy ministry said the country's output would drop to 9 million barrels per day in July from around 10 million barrels per day in May, the biggest reduction in years. This is a Saudi lollipop, Saudi Energy Minister Prince Abdul Aziz told a news conference. We want to ice the cake. We always want to add suspense. We don't want people to try to predict what we do. This market needs stabilization. OPEC Plus, which groups the Organization of the Petroleum Exporting Countries and allies led by Russia, pumps around 40% of the world's crude, meaning its policy decisions can have a major impact on oil prices. A surprise decision to cut supply in April briefly sent international benchmark Brent crude around $9 higher, but prices have since retreated under pressure from concerns about the weakness of the global economy and its impact on demand. On Friday, Brent ended trade for the week at $76. Saudi Arabia is the only member of OPEC Plus with sufficient spare capacity and storage to be able to easily reduce and increase output. It was able to respond rapidly to excess supply that weakened the market in the early stages of the pandemic in 2020 when the group of producers implemented record output cuts. In addition to extending the existing OPEC Plus cuts of 3.66 million barrels per day, the group also agreed on Sunday to reduce overall production targets from January 2024 by a further 1.4 million barrels per day versus current targets to a combined 40.46 million barrels per day. However, many of these reductions will not be real as the group lowered the targets for Russia, Nigeria, and Angola to bring them into line with actual current production levels. By contrast, the United Arab Emirates was allowed to raise output targets by around 0.2 million barrels per day to 3.22 million barrels per day. Things are looking bleak for the global economy according to McGlone, and careful discernment is needed to trade in these very volatile times. What do you think would be the next Fed rate hike? Let us know your predictions in the comment section below. Also, don't forget to hit that like button, subscribe, and turn on notifications. Thanks for watching.